So the first thing you should do is call up your broker at, Bank of America, Merrill Lynch, or Wells Fargo and move your account. It doesn't have to be to me. It has to be put in the charge of someone who actively manages your portfolio. And I'll be as clear as I can about this. If your portfolio consists of some combination of stocks and bonds, 60-40 or 50-50, depending on your age, 70-30, I don't know. If you think that's going to protect you from this next crash, you're completely mistaken. Because as Mr. Powell is correctly does, he said one thing right, the 10-year Treasury note is 0.6%. Even if it goes all the way to zero, you'll only make a handful, single-digit return on your portfolio on the increase in the principal. You're just not going to at all compensate from the crash in asset prices that are coming. And you think about also how much more inflated will asset prices grow. We're already at 180% of GDP, the total market cap of equities, which is totally in the twilight zone in history. Well, what will that be? So let's just say we have total market cap of equities, 200% plus of GDP. You have corporate debt as a percent of GDP, 80%. Let's just make some assumptions based on historical trends. And then we have insolvent debt and intractable inflation. And then the Fed has to do what? Start slamming on the brakes and he ends QE abruptly and he has to start jacking up interest rates. That's why you have to have an active manager, because the crash from the thermosphere, as far as asset prices are concerned, is going to wipe out investor savings, and it's going to do so very quickly.
Welcome back to Liberty and Finance. We have a returning guest that our viewers watch for. This is Michael Pento, the founder of Pento Portfolio Strategies. He joins us this Thursday, September 17, 2020. Michael, thank you for coming back on the show.
Always a pleasure to be on with you, Dunnigan.
You've spoken with us several times in the past about these extraordinary times that we're living through. It's baffling and bewildering for most ordinary people, and admittedly, most of us have had far from the financial education that we really should have gotten just to be informed members of modern society. But these times are so bizarre that probably anything that's going on right now is not something that would have been covered in any normal financial education that we would have received. So we wanted to get you on because you keep a really close eye on this and you've got a better handle on what's going on than so many people. If you could give us your take of some of the extraordinary events that are unfolding here and then bring it down to what does it mean to the ordinary person and how it's going to impact our lives. One starting point would be the Federal Reserve meeting that just happened yesterday, where we saw some rather extraordinary announcements about basically years, as far as the eye can see, of near zero interest rates and that sort of thing, and the Fed standing at the ready with unlimited reserves, whatever that means in a face where almost every sovereign government and many states and many municipalities are bankrupt or near it. Or anyway, can you just give us Michael's view of sort of this strange reality we find ourselves in and why it matters for ordinary people?
Well, it matters for ordinary people in many ways. So let's just say ordinary people. First of all, it matters, I guess, for the middle class because it's becoming an endangered and maybe even extinct species. Mr. Powell's conference was talking about, he wants 2.5% inflation, 2.5% on the core PCE inflation. And one reporter asked him, he says, why do we need inflation? Why is it so important to get inflation up above 2%? And he says something like, well, we need rates higher so we can lower them in a recession. And I'm thinking, well, first of all, Mr. Powell and et al., all the rest of the central bankers, going back all the way to, I guess, Alan Greenspan. I mean, you've been pushing on the yield curve down rate suppression for decades now, and through various iterations. And now it's become completely hysterical, where he's now saying he's buying $120 billion a month of treasuries and mortgage-backed securities, which I don't even believe. I'm going to touch on that in a second. But if I was in the middle class, I mean, if I was a regular guy, lower or middle class individual, and I'm saying, wait a second, you're destroying the purchasing power of my dollars, of my currency, to the rate of at least 2% plus a year. And by the way, and I always say this, and I hope I don't get, it doesn't sound staid to your audience. Remember, it's 2% inflation the way the Fed measures it. So it's core PCE. And that means that in reality, inflation is much higher than 2% already. And whenever it gets to 2 or 2.5% inflation and remains there for many, many, many years, the real rate of inflation is going to be close to 10%. And so, you're losing your purchasing power. If you're in the lower middle class, you don't have a lot of stocks, maybe you're renting your home, or maybe you don't have a very big house. Maybe you only have one house. But there's all the rest of us who have, multiple houses and a lot of money in the stock market. We're doing pretty well. And then there's those of us who have none of that and are wondering, why am I paying 35, 40% of my income on food and fuel and clothes? I don't have discretionary, and when you include shelter in that, almost all of my income is gone. 40% of Americans
medical,
don't have $1,000 to their name, and yet if you think about all the silicon bozos out there who had access to, and I call them bozos because, and it's pejorative because of this fact, they own hundreds of millions of dollars in an IPO called Snowflake. And what happens, I know this is a long answer, but it's so funny. So the IPO is supposed to go out at 120. He's making everybody, all these initial investors, hundreds of millions of dollars, if not billions. And then it goes to the New York Stock Exchange. It's supposed to open up, I think it's supposed to open up at 240. It opens up at 240 for 2 seconds after it didn't open up for hours. So the specialist, I used to work down there, so I know what I'm talking about, okay? The specialist opens up the stock after waiting for hours, opens it up for 2 seconds, and then halts it almost immediately. And where does it open up again? At 300. So whoever got in, wasn't me, wasn't my investor, whoever got in at that, that small window, bought the stock at 240 and was able to flip it at 300 in a matter of an hour, or a few minutes when they reopened the share. So the general public got screwed once again. That over and over again, the Fed is missing the point. They're missing the point that the economy doesn't need any inflation at all to function very nicely. Thank you very much. It could operate very fine and even better with zero or even a negative inflation rate, with disinflation, with deflation. Doesn't need 2%, but private equity Powell needs 2% plus inflation to keep his boys in the stock market filthy rich. Sorry for the long answer, but you got me excited.
No, I think that whole concept of inflation by policy is the most insidious and corrosive and immoral thing that most people don't even understand how that hurts them. They're told, oh, this will help because it'll make your wages go up, or oh, this will help because it'll make the value of your house go up, or something like that, or it'll make it easier to pay off your mortgage, or something like that. But there are so many more ways that just deprives us of the value of our wages, and it corrodes the value of our savings, and it just siphons. It's just an absolute cowardly tax on ordinary people. And you're right. It's a reward, a boon to those who know how to position themselves around that. Okay. Besides that, anything else extraordinary or noteworthy that happened either in the Fed meeting or since we had you on a little over a month ago?
Well, I just for you and your audience, I printed out. I don't know how well you can see it there. Can you see it?
I'll bring up. I know what that is, and I'll put it on the screen for folks. Yeah.
Okay. This is a chart of the Fed's balance sheet, and in March it took off. On a rocket ship, all the way to June. So this is an increase of over $3 trillion, $3.2 trillion. It took about 5 months for the Fed's balance sheet to go from where it was around almost 4 trillion, a little under 4 trillion, to over 7 trillion in a handful of months. Done again. It took 6 years for the Fed's balance sheet to go up that same increase in the wake of the Great Recession. But here's the point. That's not the point I wanted to make. Jerome Powell at his news conference says, we are going to continue to print, monetize Treasury and agency debt and mortgage-backed securities to the tune of 120. Yes, that's right, $120 billion a month. This is what he said. I didn't say it. He said it. $120 billion a month. Now, at the peak of the Great Recession debt monetization, we hit $85 billion per month. So here's the chart. I want to show you. So here's June, and my finger's right here, June of 2020. And here's September. If you notice, the Fed's balance sheet has shrunk by $100 billion. Now, I know the runoff for the balance sheet isn't $120 billion a month. So what is Mr. Powell being mendacious when he says that he's still printing $120 billion a month and monetizing that debt? But that press conference was a disaster. He lost all credibility. I mean, why is he saying he's printing $120 billion a month when he clearly hasn't? The balance sheet has shrunk by $100 billion in the past 3 months. That's a fact. He puts it out. I mean, it's his own balance sheet. So it's shrinking. And it was also an absolute disaster when he tries to explain to the public why we need 2% inflation. So on all fronts, he shows his incompetence and his mendacious nature.
For the ordinary person who's trying to understand whether they need to take any changes in their action of where they have their nest egg or where they have their assets that they're trying to bring together to put something for a rainy day, or for if they ever get laid off, and many people have already been, or to have something for retirement, or to have something to hand on. What does this mean to them? What does Powell's official policy statement mean to them?
Well, that's the big question, Donnie. That's what I'm asking myself right now. I manage money for a living, as you know. So if Powell says he's printing $120 billion a month, but he's not doing it, well, what is he really doing? I need to know. Now, we're going to have another update of the Fed's balance sheet today, okay? Today's September 17th, right? Today's September 17th. That's when they'll update their latest balance sheet. I want to see, because last week it increased by $6 billion. It's supposed to go up by $120 billion or thereabouts, minus whatever is maturing. So what is he really doing? And here's what I found also shocking yesterday was that he says he's going to stay at 0% all the way through to the beginning of 2024. And he says that he has this inflation target of north of 2%, but according to the dot plots, he doesn't even get there. So he doesn't even get there in the next 3 years. So, I mean, by saying you're going to get above 2.5%, that doesn't mean you're going to get there. So there's a complete lack of credibility for Mr. Powell. But you asked me, what should you buy? Well, I'm an active manager. So the first thing you should do is call up your broker at, Bank of America, Merrill Lynch, or Wells Fargo and move your account. It doesn't have to be to me. It has to be put in the charge of someone who actively manages your portfolio. And I'll be as clear as I can about this. If your portfolio consists of some combination of stocks and bonds, 60-40 or 50-50, depending on your age, 70-30, I don't know. If you think that's going to protect you from this next crash, you're completely mistaken. Because as Mr. Powell is correctly does, he said one thing right, the 10-year Treasury note is 0.6%. Even if it goes all the way to zero, you'll only make a handful, single-digit return on your portfolio on the increase in the principal. You're just not going to at all compensate from the crash in asset prices that are coming. Just to tell you why I think a crash is coming for one reason. Well, let's just suppose Mr. Powell and the rest of the Fed, merry band of counterfeiters, ever achieve 2.5% on the core PCE price deflator index, okay? And the real inflation rate is closer to 10. What do you think is going to happen between now and then as far as the amount of debt that's being piled up on that already insolvent pile. We have this year we have a record amount of corporate debt being issued. I think it's about $2.5 trillion. So that's high grade and investment grade, junk and investment grade debt. That's a record amount of debt being issued on top of the already insolvent dung pile. That was already, I think it was 45 to almost 50% of GDP, which was a record before the Wuhan virus broke out. So you're talking about, $10 trillion in corporate debt. That's up 25% in 1 year, and that year's not even over yet. We still have 3 months left. So in 2024, think about all the zombie corporations that are piling on more debt. And you think about also how much more inflated will asset prices grow. We're already at 180% of GDP, the total market cap of equities, which is totally in the twilight zone in history. Well, what will that be? So let's just say we have total market cap of equities, 200% plus of GDP. You have corporate debt as a percentage of GDP, 80%. Let's just make some assumptions based on historical trends. And then we have insolvent debt and intractable inflation. And then the Fed has to do what? Start slamming on the brakes and he ends QE abruptly and he has to start jacking up interest rates. That's why you have to have an active manager, because the crash from the thermosphere, as far as asset prices are concerned, is going to wipe out investor savings, and it's going to do so very quickly.
We've got several questions about that eventual end that's coming. Black Oak Property Maintenance says, Rob Kirby just said on your most recent interview with him that he does not know the timeline, but he is certain of the ending. Does Michael Pento share those same sentiments? In other words, what do you see as the big end, the big finish to this set of unfortunate event that's happening now, regardless of the timeline?
So I've been on record very clear about that, and I just mentioned it. It's the inflation and insolvency implosion of the bond market. That is when this whole charade ends. Once they generate their asinine 2.5%, whatever they call it, inflation rate, that is when they're going to have to slam on the brakes. And when they slam on the brakes, I just mentioned the whole charade ends. Here's the fact: central banks can always try to monetize in order to ameliorate a recession or a crash in the stock market. They can always print money. That's what they can do. They have all these supposed tools, but the main tool is to monetize debt in various forms and in various kinds. They can buy stocks too, like they do over in Japan and in Europe. But here's what they cannot do. They cannot fight inflation with more inflation. And that's where their whole misguided ruse ends and destroys the entire financial structure of the United States and probably indeed the globe. And I know how hyperbolic that might sound, but let me ask you a question. I've been a licensed professional in this industry since 1991. Okay, I've been very bullish and I've been very bearish throughout my life. I've made some outlandish predictions going on a limb. Some of them, and probably a very high majority of them, have come true. When I tell you from my heart, based on math and real economics, is going to happen, I'm not trying to scare you. I'm just saying to you, through the decades that I've been a licensed professional, think about the 90s and even part of the 2000s, you never would believe that this could be the case. Would you ever believe that our central bank would monetize and have a balance sheet of $7 trillion that is avowed to increase at a pace of $120 billion a month? Okay, that's something you would never believe. Would you ever believe the Fed would be buying junk bonds or making loans in the primary market to businesses? These are things that you would never believe. Would you ever believe that the Fed would be stuck at 0% interest rates? After the Great Recession, it was an emergency measure taken by Ben Bernanke. Will never happen again. So once in 100-year storm. Well, we were back in the repo market crash. We were back into QE and back lowering rates in 2019. And here we are once again. Okay, so 11 years after the 2008 crisis, 11, 12 years after the crisis, back at zero, and at a pace of QE, supposedly, that's much greater than at the apex of the Great Recession.
That's what we keep trying to make sure that people understand. That's why we're here. That's why we're doing this channel. That's why we're doing this interview, is so people can really understand this is not normal. These are not normal times we're living in. So any actions and practices that people learned earlier in life to be used during normal times will not serve them well in extraordinary times like this.
Again, how can I ask you a question? What have we really learned, though? What lesson have we really learned coming out of the Great Recession? Was a banking collapse. It was a bubble in housing, caused a banking implosion. What have we really learned? Have we learned the dangers of low interest rates? No, we put them on steroids. Have we learned the dangers of monetization of debt, money printing? No, not at all. Have we learned the dangers of asset bubbles? In fact, Mr. Powell was asked at his conference, is there a danger of all of this money printing causing, asset price inflation and price instability? He said, no, I don't see it. He said it. No, I don't see any problem at all coming out of the Great Recession. There was no bubbles engendered whatsoever. But the follow-up question, it should have been, what the hell are we doing then going back into QE in 2019? Why were we lowering rates in 2019 3 times in the 5 months prior to the end of the year? Why? So these are unprecedented times. I mean, here's what else we didn't learn. So you think about in the year 2000, I was around then. I was a money manager back then. Think about the enthusiasm behind IPOs. You have an IPO of a very good company. Snowflake is a very good company, and we just talked about it. Snowflake is trading at 200 times sales at the peak. Not 200 PE, 200 times sales. So if every dollar of their sales went to earnings, it would take 200 years for you to capitalize your investment based on earnings. 200 years! And it's 200 times sales, not earnings. So why were people tripping over themselves buying this new issue? Because CNBS was pumping it up and talking about how wonderful it is. It's a good company, but at what price? What have we learned from the 2000 bubble? Nothing. What has the Fed learned? Nothing. What has corporate America learned? Zero. Have we learned not to over leverage our corporate balance sheets? No, they're the worst. They are in the worst condition ever. So we've learned nothing. The only thing we've learned is how to do the same mistakes over again on steroids.
I was hoping when you said, what have we learned? I thought you meant like we, not those that you've been mentioning now, because I hope that's why we're here, is to try to help people learn. You can't trust the stated official rate of consumer inflation. You can't trust the banks to be reliable guardians and custodians of your nest egg that you stick in there on deposit and think that's going to stay there and be protected for you. You can't trust that the stock markets are going to always go up 7 to 10% per year in real terms and not suffer swooning crashes and that sort of thing. And we're trying to teach people that we are on the surface of a stretched bubble, and that things will look good until they don't on that bubble surface.
Who can you trust? I mean, and I'm apolitical, but do you really trust the Democrat? You think the Democrats are trying to delay any kind of vaccine? I think in their heart they would love to do that. And I'll probably offend a lot of people here too, but do you think Donald Trump has your best interest when he says we're going to have a vaccine ready for distribution by November 1st for mass distribution? I mean, we have to be able to trust our scientists. We have to be able to trust our politicians. We should be able to trust our central bankers. But nobody believes in freedom anymore. Nobody believes in markets any longer. And what is the market? It's not Wall Street. It's the power. It's the empowering of individuals to give every person on on this planet, or especially in this country, the ability to vote with their wallet what they want to spend, what's the cost of money, how much do they want to spend on a home, what are the value of equities. There's a certain freedom there that markets provide by empowering individuals to make their own decisions, and that's gone. That is it's vanishing faster than the middle class.
Yeah, we're having John Williams from shadowstats.com on next week to talk to us about the lies that are dressed up and trotted out as the official story we're supposed to believe. So that's what we've been trying. We've been trying for almost a decade here to try to get people to trust their gut and to trust that their experience, the experience of their grandparents and their parents when they've been through crazy things like this. My mom, when she told me stories of my grandfather, rattling his newspaper in fury during the Great Depression when he saw the farmers were having to slaughter their herds rather than take them to market because the prices were so low, or dump milk into a ditch because they couldn't afford to. That waste and that destruction of value and the destruction of people's dreams and their lives, the reality of that, and that we don't live in a fantasy world, but we live in a fallen world where we can't, unfortunately, just put blind trust in official sources, but we have to trust our gut. That's what I hope we're learning, but it's very spotty, and most people that we meet. So that's why we encourage all of our viewers to share this information with others, to try to spread the knowledge among people that they meet, because it is still a countercurrent. It's not the mainstream.
Your gut? Your gut. Trust what you trust. Your eyes. Trust your ears.
Yeah.
Trust what's manifest right before you. If asset prices were included in the basket of goods and services used to calculate inflation, what do you think our inflation rate would be?
And medical costs and so on.
What about your home price? That's not in your inflation basket. It's owner's equivalent rent, whatever the hell that means. It's what you say, hey, what do you think you can rent your house? No. That's an amorphous kind of question. How about you just calculate what the comps were for my neighborhood year over year? There's your inflation in home and that's your residential real estate inflation. Yeah. You don't have to come up with some, fancy formula. And then so you can ask John Williams, and he knows better than I do. The core personal consumption expenditure price index it's the most bastardized measurement of inflation. Takes out everything that goes up through substitution, massive hedonic manipulation, and you get a rate that's very, very hard to reach 2%. Fed couldn't even get there for most of the time they wanted to. Now they want to get there and above that. And I'm telling you, you're going to have a rate of inflation closer to 10 than it is 2 if and when they ever get there. And what that means for stock prices, for real estate prices, all the assets that the Fed has been pumping up until it gets to 2.5. When they have to reverse course, think about you don't have to wonder what happened. Just remember what occurred in 2018 when the Fed said they were going to go to 2. They were at 2.5. They said they were going to go to 3.25, 3.5 on the Fed's funds rate, and continue with the watching of paint dry as the balance sheet just slowly runs off innocuously in the background. You won't even notice it, done again, until the stock market fell 30% in a matter of a few weeks. Yeah. That's what's, and everything I just said is going to happen again, but a much worse outcome because we're falling from a much higher level, thermosphere, the highest level in the atmosphere.
We've got questions related to what can ordinary people do about this. Justice American says, what should those with 401k and pensions be doing to prepare for when the music stops and the stock market corrects to fair value?
So I mentioned get yourself into an active manager if you can find one. You should buy yourself some precious metals. I start with 5% physical ownership of precious metals. That amount varies depending on the level and direction of real interest rates. And if Mr. Powell, this is the one reason why gold, we're recording today, gold's having a bad 2 days. I think the precious metals market was hoping Mr. Powell would come out and say, I am capping long-term nominal yields at X. Say, they will not go higher than 1.5%, 2%, whatever his decision was. And we would continue to monetize debt until we reach above that level. So it would guarantee that real interest rates would be negative for many, many years. So I think the gold market might be afraid of a long-term spike in interest rates. But unless you start getting, and I call this the unholy union between fiscal and monetary policy. We had it earlier this year where the Treasury said, hey, I have an idea. Let's borrow $3.3 trillion. That's the deficit for fiscal 2020. And then the central bank says, you know what? Every dollar of that I'm going to buy. I'm going to monetize permanently all of that debt. Then you have money going right into the hands of people. So the broader monetary aggregates explode higher, like we saw M2 money supply surge, and you get your inflation. So I think depending on the outcome of the election, which is very, very crucial, you have to watch who wins the White House and what's the makeup of Congress. Does the Senate maintain its Republican position? If you do get a Democratic sweep, there's nothing that's going to stop universal basic income. And our vice president candidate, Kamala Harris, has gone on record saying she would like $120,000 a year of universal basic income to basically almost everyone in America, for every family in America, to be precise. So, married couples filing jointly, I think it's well under $100,000 a year. It's most of America is going to get a huge windfall of universal basic income, and then they could all quit their job. Then again, they won't have to risk getting another virus. They could just sit home and collect their checks, remain fallow, and spend money. Buy iPhones and all kinds of iPads and wearables, and they can go and gamble. The Robin Hoodies will have plenty of money to gamble in the stock market, and everybody's going to be happy as inflation soars way past the Fed's ridiculous 2.5% target. So watch the construction in DC. Get yourself some precious metals. Start at 5%, and then add to that based upon how much inflation they're going to get. And the only way they're going to get above the target, the way the Fed measures it, is through that unholy union of fiscal and monetary policy. And you're not going to get it by divided government. You're going to only get that if you have a Democratic sweep in D.C. Again, hate me if you want. All I care about is the truth. And I'm apolitical. And if you get a AOC, Alexandria Ocasio-Cortez, pulling on the suit jacket of Bernie Sanders, communicating to Mitch McConnell and Nancy Pelosi, and they're all in this cabal with Joe Biden, you're going to get much higher inflation, and you're going to get institutionalized in this country universal basic income. And once you get that, you'll never be able to take it away, ever. Sad. And you know what? Again, hyperbole, I don't use. I'm just saying, I am the one who was predicting. I predicted, I was derided regularly on CNBC. Twice a week I was on talking about the housing bubble, talking about the crash all through 2000. I started in 2006, 2007. I was made fun of all the way to the middle of 2008. Once I was proven correct, shortly after that, they threw me off the channel. But that's okay. I'm with people like you who have a larger audience and much more intelligent as well.
Well, we're also interested in what's really happening and what we're not being told, rather than what we're told to tell. So. Oh,
I'm sorry, I forgot. I hate to cut. I'm sorry, but I also highly recommend getting yourself farmland. If you can't buy farmland, you can invest in farmland. But get yourself farmland, because that's going to be crucial going forward. So precious metals and farmland. Absolutely. Unless you can get yourself, you also, again, get yourself with an active manager who measures the changes in inflation and deflation and growth and recession. So when you can ride and dance with this deadly bubble that they're building. You can happily, skip along on the upside with hedges in the portfolio. They don't always work, but it's like insurance. You want them when the poop hits the fan. But most importantly, you can identify if you're with a good manager, he'll identify when are we starting to roll over as far as going into a recession. When is the Fed's balance sheet providing a real interest rate? When is the yield curve compressing? When are LIBOR OIS spreads starting to perk up? When are break-even spreads starting to roll over? I'm giving you my model, portions of it, and then you want to say, oh, gee, we're not only going into a recession, we're going into deflation, and you better get the heck out of the stock market. And if you're with me, we'll even short it for you too.
There's a question here. You've mentioned the bonds and the bond market several times. Charm Aitken Tilpio says, does continued successful auctions of the U.S. Treasuries, 40 billion plus, mean that the U.S. equities are a solid buy?
So so what he's saying is, as long as the interest rate complex remains quiescent, then equities are a buy. I'm actually kind of sympathetic. I wouldn't say always, but I'm more sympathetic to that. So if the MOVE index, which is the volatility of bonds, if that stays quiescent and the yield curve remains, it doesn't invert, but it remains steep, but the long end doesn't get away, then that is more conducive to an environment where you want to be long equities. Absolutely. But you have to watch out. Remember in 1987, we had a crash, 23% one day on the S&P 500, and that won't happen again because we have circuit breakers. So it maybe be 7%.
7%. Yep, they trip.
Maybe it'll take 3 days. 3 days to get there, and then the fourth day it'll be down. It'll be down 30%. So 30%. So here's the thing: you have to remember that in 1987, inflation was starting to rise inexorably, and interest rates were starting to rise inexorably. And that's when the market crashed, because the market realized the Fed is going to have to once again raise interest rates like it had to do in 1980. So 7 years ago, they said in 1980, 81, Volcker had to raise rates to 20%, destroyed the inflation, but also destroyed the economy as a consequence. The traders in Wall Street, they go, oh my gosh, we're going to go through something like that again. Let me get out of harm's way, because the stock market was miserable, as you know, in the late 70s, early 80s. And it caused it to crash in one day. But this time, if that happens again, and the answer to the question that the person asked, if we start seeing the long end of the yield curve start going, 2.5%, 3%, start to spiral out of control because of inflation running above the Fed's target, and the Wall Street traders say, oh, Mr. Powell, you may not be doing it yet, but you're going to have to slam on the brakes. We're going to have a crash, just like I said, 7%, 7% down per diem. But instead of crashing in 1987, the total market cap of GDP was like 40% of the economy. So 40% prices to GDP. Now it's 180, probably heading to 200. Imagine where we're going to crash from. The national debt, again, 35, 40% of GDP. We're at 136% national debt to GDP. Imagine what's going to happen when you have the triumvirate of real estate, stocks, and bonds all in a bubble, and they crash all at the same time. 23%, that's your starting point. Yep. Watch out for inflation. Get with an active manager, or you will not, you're not going to have a very good retirement. And we're all about here at Pento Port, not that we do everything right. We make plenty of mistakes, believe me. But we get a lot of things right, too. We're all about preserving your purchasing power and increasing your standard of living, no matter what those monkeys in D.C. do. And I call them monkeys. It's horrible. I call them that, and I'm deliberately pejorative, because nobody, you didn't, I didn't, nobody in your audience, nobody voted for Mr. Jerome Powell. Mm-hmm. And he doesn't have the right legally. He has all these emergency powers. The Fed can do anything it wants, really, using this cover of an emergency. But nobody gave 1913 Act of Congress, never intended for the Fed to own the stock market, to own the bond market, to own the real estate market, to own the economy. They were supposed to be a lender of last resort in an emergency, a penalty rate at the discount window. You could take your treasuries if you were a bank, go to the discount window and say, I need cash. And the Fed would say, okay, here's your money and here's a discount on the principal of your treasury, whatever AAA backed asset you came to the window with. It was never, we will buy unlimited junk bonds. Done again. It never was. It was never, we will never again have a downtick in the stock market. And it sure as heck was never, we will provide a 2.5% inflation rate from now until whenever we decide we don't need it anymore. Never.
You mentioned equities in a few cases there, and you mentioned metals. There's the coming together of those in the mining equities. George Lincoln says, please ask Michael why, of all the mining equities available, he chose to add Barrick to his clients' portfolios, especially with their history of selling forward.
Well, I think it's one of the safest. It's a great question. It's one of the safest gold mining firms out there. As a matter of fact, the CEO said that he could be profitable with gold at $1,200 an ounce. So I expect volatility in the gold market. I don't think it's going to be a straight moonshot to $6,000 an ounce, although I think it's eventually going to get there. I've owned Franco-Nevada in my portfolio. I've owned Hecla Mining in my portfolio. I've owned many mining shares. Barrick Gold has done very well for us, so I'm not apologizing for it. I just wanted to own. Here's even a better reason for you. So if you like gold, the metal, you should like the miners even more, because the miners are an exponential play on the asset. So it's a leverage play on the asset, the underlying metal. But if in the event we have a pullback in gold, and one of the reasons why I think there could be a temporary pullback in gold is all this vaccine hype that they're talking about. There's a tremendous amount of hype about a vaccine. And if you remember back in 2012, when the economy started to heal initially from 2011, 2012, started to heal, and you saw the deficit starting to come down on an annual basis, gold got murdered, and gold mining shares were slaughtered. So you have to be very, very careful when you own gold. Can't be 100% of your portfolio. Can't even be 50% of your portfolio. You have to be careful when you own it. I think it's a long-term play, but I'm also very cautious until we get over this vaccine. I think after the vaccine comes out, might be a time when you could start expanding your ownership of miners into even in the juniors as well. But not until then. We're kind of like in this I call it the vaccine dead zone, where gold might be afraid of a vaccine that supposedly will send everybody back to work, which is not. Unfortunately, it's not going to happen. First of all, many people will not take very high percentage of individuals will not take this vaccine. We don't know how efficacious it will be at this point, and we certainly don't think it'll be distributed to the general public anytime in the year 2020. So the vaccine announcement might give us an opportunity to buy gold at a cheaper price, both the metal and the miners. But I don't think we really have to worry about the economy healing in any sustainable basis at the earliest, in the middle of 2021. And that's a big if. So many other factors go into that calculation, believe me.
On the bigger picture, geopolitical, financial realm, Just Me says, why can the USA just keep printing fiat? Is it because no other country will dare to challenge the USA because we have the best military in the world? Plus, it's easy to manipulate policymakers. We can just buy them off, or worse, if they don't comply. But will anything change until we get to Dow 40K or next?
Who can print by fiat? What was the first part of the question? I'm sorry.
The USA.
Oh, the USA. Print. Well, listen, if we were a banana republic, then our currency would have already collapsed. I mean, if you look at our deficits as a percentage of GDP, they're at 17%. The annual deficit is 17% of GDP. And if you look at our national debt compared to our revenue, we're at 970% of revenue. So by any metric, we are a banana republic. But we are the world's reserve currency. And what happens in times of chaos, people in the good times, people borrow dollars and invest in other assets overseas, higher yielding currencies, higher growth rate currencies in their nations. And then when things go bad, people buy. They have to sell their. They have to sell their renminbi. They have to sell their yen. They have to sell their, you name it, lira if they're in Turkey, and buy back the dollar. So that's a strengthening dollar. So there's a lot of reasons for a stronger dollar. Although I think the dollar is weakening over time because it's losing its world's reserve currency status. But to be perfectly honest with you, if we were a banana republic, if the U.S. dollar, if our nation, was not the world's reserve currency to start off with, we would have a currency collapse like we saw in, say, Zimbabwe. That would be especially true if every other fiat currency, major global currency, wasn't doing the same thing that we're doing. So it's a big currency debasement derby. And the U.S. comes out yesterday and says we're unlimited QE, 120 billion a month. Then the euro, the ECB comes out and says, and the Bank of England says, we might flirt with negative rates soon. And so it's like, do I buy the dollar? Do I sell the dollar? So everybody's doing the same thing. But again, if the U.S. wasn't the world reserve currency and everybody else wasn't doing what we're doing, we would have the Hungarian pengo. That would be the fate of the U.S. dollar. So, it's just a couple of degrees of separation there.
Yeah, we've had Alistair McLeod from goldmoney.com on, and he's still maintaining his dire prediction of a fiat currency crisis by the end of this year. Mm-hmm. Do you see, you've certainly described unhealthy practices and policies and trends and a race to the bottom of all fiat currencies, what you just described. Is like they all jumped out of the plane, we're all in free fall together. Do you believe it's likely that, in your view, that there will be a currency crisis or banking crisis yet this year?
I have to say I agree with Alistair McLeod. I mean, I don't understand why people have any faith in any central bank any longer. They've proven over and over again that they lie to people. They've proven over and over again that they cannot be trusted as far as supplying a real rate of return for their savings. So I don't understand why it's taken so long. But clearly, if you look at the price of gold, if you go back to the year 2000, gold was at like $200 an ounce. Okay, we just went from $200 to $2,000 an ounce in 20 years. So it is happening. It's a slow process. I think that process might be expedited globally. So you'll see all fiat currencies, not vis-a-vis each other, but against farmland, against precious metals, against hard assets, crash concurrently. That is a prediction that I've been making for quite some time. I just don't know when it's going to happen, but clearly it's a process that is already occurring. I would also predict that the rapidity of it will increase.
Okay, and while we were discussing, we got another question in, but I think you've already answered it from Online Advertising Net. Says, does Mr. Pento acknowledge the real current inflation rate is closer to 10%, not even close to 1%? And that's what you've said on a couple occasions.
I think it's at best, the lowest it is mid to high single digits right now in reality. But I think it goes to double digits if and when the Fed ever measures it. It's being core PCE deflator, at core being X food, X energy. Core PCE deflator ever gets to 2.5, we're at 10 plus in reality.
Michael, if people want to take advantage of the services that you provide, where should they reach out to you?
The email address is mpento@pentoport.com. The website is pentoport.com. You can call the office directly, 732-772-9500. Nobody here bites. We can pick up the phone, have a conversation, and discuss. If you have around $100,000 to invest, we'll put you, if you're qualified, into the IDEC model, which has a pretty good reputation and a long history now of protecting and profiting from these chaotic declines in the stock market, but also kind of safely riding up these bubbles while they're building. So I don't know when this next one's going to crash. I mean, I could guess, in the next, there'll be many cyclical bubbles that break, but the big bubble that's going to crash in the next couple of years is going to be something like we've never seen before in this country. devastating in nature. And again, that's whenever we being the powers that be, the Treasury and the central bank, provide a devastating blow to the middle class with a north of 2% inflation rate, the way they measure it.
Well, Michael, thank you for joining us. We've been speaking with Michael Pento, the founder of Pento Portfolio Strategies. You can find him at pentoport.com. And Michael, just thank you for coming back on Liberty and Finance.
Always my pleasure, Duncan.
To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com, Bullion Sales. You'll see my name, Dunnigan Kaiser, my phone number, and my associate, Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.